Welcome to our monthly live stream. We know crypto taxes can be hard, can be complicated, can be stressful. So every month we sit down with two tax experts to answer your questions. So with me today, I have our head of tax strategy, Jordan Bass. He's also the owner of the firm Tax and Cryptocurrency, and as you guys will see, he knows so much about the ecosystem. Next is Miles Brooks. He's our director of tax strategy. He's our in-house tax expert, and he does a fantastic job breaking down the crypto tax implications of pretty much any transaction that you could think of. Well, let's get this thing rolling. First, a short disclaimer though. None of what you're about to hear is uh, specific tax, financial, or legal advice. This is all for general informational purposes only. Well, as we all know, there's a little bit of a market downturn happening right now. So, Jordan, Miles, can you tell us a little bit about the steps that investors can take if they want to reduce the amount of capital gains they pay maybe later in the year if things start to turn around? We'll start with Jordan.
Yeah, sure. So, I mean, at the end of the day, there's not much that we can do for the prior year, right? For 2021. That year is kind of closed, just like a business would. An individual has effectively closed their books on the year. No transactions are really going to impact 2021. But like Daraj mentioned, there's always the ability to, minimize capital gains that you're generating throughout the year, even if that's done in the beginning of the year, where you harvest some losses at the beginning of the year to offset some of those future gains. So if anyone is sitting in an unrealized loss position now and they're a little uncertain with what's going to happen with the market, they have the ability right now to sell that asset, maybe purchase it back at some point in the future. Again, we still have to see what happens with the Build Back Better Act, if that passes, and how that impacts wash sales with crypto. But you still technically have the ability to buy back that asset and speculate on the appreciation and value from there while you've harvested the loss. So if you want to hold that asset for a long period of time, that is a viable option right now. But like you said, Daraj, this is something that we're looking at for 2022. 2021 is pretty much closed. So how that process works is the same way it would have worked if you were harvesting your losses at the end of the year in 2021. You look at the portfolio, leveraging software like CryptoTrader.tax, and see what is in those unrealized loss positions and sell them, harvest the loss, and do what you want with the proceeds after that. Like I said, whether you want to reacquire that asset or maybe move funds somewhere else, maybe you want to sit in Stablecoins for a little bit to see what happens with the market. But there are always opportunities to take losses. No one ever wants to do it, but they do have a tax benefit down the line.
Got it. Got it. Well said. And just a little bit of context for those of you who might not be aware. The Build Back Better Act had this provision that would have introduced the wash sale rule to cryptocurrency. So right now, that restriction kind of exists for stocks and equities, where if you sell a stock for a loss, and then you immediately rebuy it, you won't be able to claim it as a capital loss on your tax return. Currently, that restriction doesn't apply to crypto. The Build Back Better Act would have introduced it, but as you guys know, it was stalled in Congress. So we'll keep an eye out on that. But Miles, anything you want to add on to Jordan's answer?
Yeah, Jordan hit on everything, but it's important to note that you may have those losses, but you have to realize those losses. And so you need to then trade your whatever coin you have that may be in a loss position. You need to transact with that. So you need to either exchange it for stablecoin, exchange it for Bitcoin or ETH, whatever it is. That will realize your losses, and then you will then report it on your return. Something to be careful of if you're realizing those losses now, if we do end up going into a bear market and you do have a overall net loss kind of position, by the end of the year, you can only deduct 3,000 of your capital losses against your ordinary income. You won't be able to deduct more than that. Everything else gets carried on to the next year. So you do want to harvest your losses if you have those losses, but you'll want to offset it with gains later in the year.
Got it. That makes sense. So I guess for a better idea of how this works, and Miles, you can let me know if I'm presenting this accurately. But let's say, I can sell my Ethereum right now for $1,000 loss. If I was to incur a $1,000 gain later in the year, that would offset. Is that essentially correct?
That's correct. Your losses and your gains throughout the year get netted against each other, and that kind of gives you your net gain or net loss for the entire calendar year.
Got it. And I think calendar year here is key. As Jordan mentioned, not, well, pretty much nothing you could do about 2021 now, but 2022, still fair game.
That's right.
All right. Awesome. So we do have a few questions from the audience. Let me read off a couple from Twitter. So the first one is one for me. Someone asks, when is the Ethereum wallet connection for CryptoTrader.tax coming out? So I will say there has been some delays, but our product is in the home stretch. It's coming out very soon. And I've tried it out myself. It's awesome. So you'll be able to copy paste your Ethereum wallet, and we'll be able to calculate taxes on NFT DeFi transactions. It's going to be a game changer. So thanks for that question. So here's another question. Someone asked how you report scams and rug pulls on your tax return. Is there any way to deduct those losses, or not really? Miles, we'll start with you.
Yeah, and that's a great question. And this is one of these gray areas where users within the crypto space aren't sure when they are able to deduct casualty losses, losing your coins, or investment losses like a rug pull. It's important to differentiate that losing your coins, getting your coins stolen, that's considered a casualty loss, and that's no longer deductible with the TCJA, the Tax Cuts and Jobs Act that was signed back in 2017 by President Trump. So that is no longer available to deduct those casualty losses. So that's really unfortunate. However, you're still able to deduct an investment loss. If you invested in a coin and it rug pulled and now your coins are worth $0, well, you can realize those gains and you can report $0 of proceeds or whatever the proceeds you get from it, if it's a 99% drawdown, etc. And you'll be able to take the losses by reporting the transaction. You'll have $0 or close to $0 of proceeds, and you'll have your basis, which is whatever you paid originally for that investment, and that will give you a loss which can offset other gains that you may have.
Got it. Okay, Jordan, anything you want to add on there?
No, I think Miles brings up a really good point for everyone to understand, because I get this question a lot at the firm, which is specifically what happens if there's a rug pull, right? Or what happens if I was scammed and there was like a theft? And Miles brought a great point. They're very different because, like you mentioned, theft loss, casualty losses, they're still in the code, but they have to be like based off of a federally declared disaster, right? And that's not going to happen when someone loses their ETH, right? It may feel like a disaster to you, but it's not a federal disaster, right? So ultimately, there's no real way to write that off or to take that loss anymore. But like Miles mentioned, the investment loss portion, if you're going to classify something as I entered into this transaction for the purpose of generating a profit, which is pretty much the entire reason to speculate in the crypto market, and now that asset's worth nothing, and maybe there is a little bit of liquidity left, because most of the time, obviously, these rug pulls don't happen on centralized exchanges. But if there's a little bit of liquidity left to actually dispose of that asset, yeah, you'll have triggered a taxable event, just like Miles said. So you might get something very, very little of value in return. You may get nothing of value in return, but then I don't think the transaction would process. But yeah, that would be technically, like Miles mentioned, an investment loss. We would show that on the complete reconciliation of, let's say you have 100 transactions, let's say you have thousands of transactions. It would be in there. And just like, again, like Miles said, whatever your cost basis was, whatever you acquired that asset for, would effectively be what your loss is. It's not the peak fair market value of that investment. It's not, oh, I bought something for $2,500 and it went to $10,000 and then it rugged. I don't get the $10,000 loss, right? It would be whatever your basis was in that position. So it's a really important distinction. If somebody steals your funds, if you do, lose your keys or lose access to a wallet, there really honestly currently isn't much based on the tax code that we can do. You would probably have to talk with your tax advisor, talk with your CPA, and see if there's something strategic that you can do to try to mitigate that loss, right, and offset it or write it off. But from the code, there's not really much we can do unless, like Miles said, it's an investment loss.
Got it. Got it. And here's a follow-up question from Dan on that. So I guess he was just looking for a little bit of a clarification on that. He asks, offsetting your losses with your gain is only if you sell, the crypto that you purchased. So yes, this is kind of what Miles was talking about earlier when he said you have to realize that loss. It's not enough if you're just holding that cryptocurrency, but you have to either sell it or trade it for another cryptocurrency, just dispose of it in some way. So here's another question, and a little bit general. How is NFT play to earn games taxed? So a little bit of a complexity to this, but Jordan, you want to take this on?
Yeah, so every, P2E, every play to earn game, effectively, not everyone, but most of them have different structures. But ultimately, income is income, no matter how it's derived. And so if you're playing a game or you're doing something in some ecosystem and you're generating yield, because that's effectively how we would classify that, it's treated as and taxed at ordinary income rates. So if somebody has a specific, if they're super into the metaverse and they're really, really heavily into these play to earn ecosystems, and they're, earning proceeds and they have expenditures, maybe they're scholars, and whatever the process is, whatever game they're playing, there will be income that they're generating. There most likely will also be expenditures that they have. So they have to treat that as almost like a business operation. And most taxpayers will probably end up using something called a Schedule C, like a sole proprietorship, and netting out those profits with the expenses, right? Income, expenses, net income. Most likely, some people in this ecosystem, they have organizations, they have entities, they've raised money, and they're doing this from like an investment standpoint, and so their reporting requirements are a little different. But ultimately, at the end of the day, what's happening is if you're generating income, you have to report it as such, and you will pay tax at ordinary income rates. This isn't something where it's like, well, first of all, it would be short-term activity, even if you were deeming it to be like an investment where you're getting capital gains on it. But that's just not how the structure works. It's income. It's like yield. It's like de facto interest. It's whatever you're doing in that ecosystem and generating income. It is income. You're paying ordinary income tax rates. But as previously mentioned, you do have the ability to possibly minimize that amount by having some expenditures that go along with the actual game or the actual ecosystem that you're involved in.
Got it. Got it. Right. Because business expenses are typically deductible, right?
Yeah, and we see a lot of people treating this. I mean, you could say it's a hobby, and that hobbies, you don't really have obviously the ability to deduct expenses in excess of income. Maybe you can wash them out, so you're not really paying any tax. You have some income that you're generating, you have some expenses. If your expenses exceed the income, we don't get really the benefit because we treat it, as a hobby. It's not something that you're actively engaging in for the purpose of making a profit. But these, play to earn gamers, these people that are generating income from these games, it's a little different. It's not really a hobby. They're doing this and they're actively engaging in it, and it's more of like an investment. It looks more like a business. So yeah, Diraj, exactly like you said, you have these expenses. They're technically, right, theoretically, and actually, they're factually ordinary and necessary business expenses to facilitate the gaming activity. So you would be able to deduct them as ordinary and necessary business expenses. You might have to classify them, and using a platform like cryptotrader.tech, you can aggregate all the expenses and then go back in and classify what is what. But ultimately, at the end of the day, it's income when you derive the income, and there are expenses that are coinciding with that income generating event or events.
Okay, well said. Miles, anything you want to add about NFT play to earn games?
Yeah, I think to give some context of like, why are these games taxable as income? We've played other games that aren't play to earn in the past. What sets these games apart from kind of the old school game that we know? Well,
Yeah, like
basically,
World of Warcraft, you mean?
yeah, World of Warcraft, any game where you can kind of earn money, why isn't that money taxable? Well, it's because in a World of Warcraft situation, that gold isn't worth anything outside of the game. You can't trade it for US dollars and cash out. However, in these play to earn games, all of the assets are exchangeable for Ethereum or for another asset. You can sell your in-game characters for ETH and move that money from your in-game wallet to a centralized exchange or to your to cold storage, for example. And so because there's that exchangeable piece to it, you can sell your character, you can sell your assets. That's what the IRS looks at to say this is a play to earn game. This should be taxed as income. That's the main difference.
Got it. Got it. Okay. Yeah. Unfortunately, leads to a lot of complexity from the gamer's point of view, but it's the IRS, to be expected. So here's a question that's more for me. Someone was talking about they were having some problems with a couple of their imports. So we were having some issues when we switched over to this new app, but we've gotten a lot of them resolved. One thing I'll say is that our support team has been doing a great job. So if you let us know through our support chat or through Twitter which imports you're having troubles with, we'll make sure to get that fixed as soon as possible. Thanks for letting us know. So here's a question from Bianca, kind of related to the discussion we were having earlier. So if my NFT goes up in value, but I don't sell it, is that taxable? Miles, you were talking about this earlier. Do you want to answer this one?
Yeah, and this is a great question and highlights what we were talking about. Just because an asset has appreciated in value doesn't necessarily mean that you owe tax on that appreciation. You'll need to then dispose of the NFT, excuse me, either sell it for ETH, sell it for fiat dollar, or even do a trade NFT to NFT. It's not until you get rid of that NFT that you then calculate your gain or loss on that asset, depending on how the price has fluctuated since you originally purchased it. Important piece is you need to realize that loss or gain. In this case, if your NFT goes up in value, which means you'll have to sell it or dispose of it in a certain way.
Right, right. So simply just holding the NFT in this case would not be a taxable event.
That's correct.
Awesome. Yeah. So here's a question from Dave, kind of following up on our discussion about harvesting losses. This is a question about wash sales. He asks, can I sell and buy back the same coin immediately, or do I need to wait a time period or buy a different asset? So as I kind of touched on earlier, the rules for cryptocurrency are a little bit different than the rules governing stocks and equities. Jordan, you want to take this one on?
Yeah, so it's pretty much exactly at a high level what we discussed earlier, but I want to add something to that specific question. So yeah, of course, depending on what happens with this Build Back Better Act that Diraj actually kind of gave us a nice overview of a few minutes ago, it will impact the treatment of what was being described, right? If you buy something, sell it, and then reacquire it, but you've harvested that loss, are you able to now recognize the loss? The key distinction in this question to me is the question is if I sell it and then buy it right back. Now, some people are of the opinion that you should probably wait a period of time. The crypto market moves really, really quickly. So, what is a period of time? Maybe an hour, maybe 30 minutes, maybe a day, but you just want to make sure that that transaction is respected by the IRS and it doesn't look like you actually didn't sell anything at all, right? That you actually were just harvesting this loss to take advantage of certain rules in the code. Now, I've never seen something be enforced in that manner. We've had clients that sell something and then buy it back within minutes, and it's reported as a loss because there's nothing in the code that would substantiate that you can't do that. But there are certain doctrines that would maybe, treat that transaction as like it's not a real transaction for tax purposes. However, I don't think people need to necessarily worry about that. And most times when people are tax loss harvesting, they're not necessarily reacquiring, selling and reacquiring almost in a transaction right after one after another. Regardless, you still can do that. But that's just for now. I do think, and I'm of the opinion that if the Build Back Better Act passes, it will be on a go forward basis. Like most tax provisions, but they could also retroactively, apply it till January 1st of 2022. So ultimately, at the end of the day, it's advised by most people to wait a period of time. But in theory, how it would work is if you sell something and you have, like Miles says, a realization event and a recognized loss, and then you reacquire it, and there's nothing in the code specifically for wash sales applicable to crypto, technically that transaction should and most likely would be respected regardless of the period of time. It's just some tax advisors would say maybe wait a little bit to reacquire. I'm of the opinion that a loss is a loss, and then you reacquire a position, and you reestablish your basis in your holding period.
Well said. Well said, Miles. Anything you want to add on the topic of wash sales?
Yeah, I agree with Jordan. I think you have to be a little bit careful, though, if you are selling and buying back immediately after. There's something called the economic substance doctrine, which is not in the code. It's not like written law. It's more case law settled by judicial courts, and it basically says if there was no economic reality behind your transaction and the transaction was solely for tax purposes, it's possible that the IRS comes in and reclassifies your transaction, wash sale rule or not, with crypto. And so I think you have to be careful with that. However, crypto moves so quickly that you could buy back an hour later, 2 hours later, and there's economic movement going on. The coins are fluctuating in price, even if just slightly. We know there's high volatility in crypto. No one knows when the next 10% drop is going to happen. And for that reason, if you wait just a little bit, I think is the safest way to go about it if you are harvesting your losses.
Got it. Got it. So I'm looking at the chat. We have a couple of questions about staking rewards. So I guess it'd be good to just get a little bit of an overview of how I could potentially calculate rewards on my staking, or sorry, calculate taxes on my staking rewards if I'm receiving them on a daily, weekly, or monthly basis. Jordan, you want to start this one off?
Yeah. So rewards, yield, any sort of income generation event, you're generating income at the time that you receive the reward. there's a lot more nuance to this specific question, and we may not have enough time to talk about it in depth, but we can go over it at a high level at least. But it's income upon receipt, whether you're receiving it daily, weekly, monthly, whatever that is. Once you actually have receipt of those funds or dominion and control over those funds, or constructive receipt, there's a lot of doctrines, there's a lot of tax verbiage that you can talk about to determine when income is recognized, when income actually should be recorded by the individual. But staking rewards are taxed like ordinary income. Now, there is an argument to be made that certain types of staking rewards, certain types of yield, depending on what type of activity it is, the underlying activity that's generating the yield, like if you're running your own node, let's say, some people would maybe make the argument that that's like a rental type of income, a different classification of income, same tax rate. There's just a difference in terms of the classification and characterization with all types of income, because certain other things can offset different characterizations of income. Like Miles was mentioning earlier, capital loss can only offset capital gain, and then to a certain extent, ordinary income. Well, rental income, if it's classified that way, which doesn't really work for most people, is a passive activity. If you have passive activity losses, maybe it can offset some of that type of classification of income. But generally, at a high level, what 99% of the time happens is staking rewards are treated as like other income that you would show on your tax return upon receipt. We get into issues when you have staking rewards that you have to actually claim, or you have the rebase issue, which we've talked about at length on other streams. And that gets into an issue of when does the actual income recognition happen? When does this individual have control of the funds? Do they recognize the income when they claim the rewards, or do they recognize the income when it's claimable? Some of these transactions don't show up on chain if it's in some sort of DeFi protocol. Some transactions do show up. So at a high level, what happens is once you have the ability to claim these rewards, once you actually are generating this income, that's when you would be deemed to have dominion and control over the funds, constructive receipt over the funds, and therefore that's when the income would be recognized. If you're using a software like CryptoTrader.tax and you plug in your Ethereum wallet and it's not necessarily showing all of those income generating events, that's something that maybe would need some manual supplementation on the taxpayer's end to figure out what the income is for the year. Because you don't want to say, I claimed the rewards at the end of the year, the price has gone up 2, 3, 4, 5x, and at that time now I'm overstating, right, the amount of income, because when I click claim, it comes in the wallet, I classify it as income, I'm showing $20,000 of income when throughout the year I only had $7,500 of yield that I was generating. So there's a lot of nuance to that question, but at a high level, what I think Amanda asked that question, what would need to be known is that staking rewards yield any sort of passive income that you're generating on chain or in a centralized exchange is income upon receipt. It's just, when is that receipt? That's the question. We don't have definitive answers, but taking traditional doctrines, we can kind of figure out that is how these rewards should be taxed.
Great overview. Love it. So we're a little bit low on time. I think we have 2 minutes or so left. So I do want to take this last question. This is from House Call. They ask, so let's say I bought 1,000 ADA with USDT. What does the tax rate look like for that transaction? So buying crypto with a stable coin, I guess, in this case. So Miles, you want to take this one on?
Yeah, that's a great question. If you have USDT, that's considered a cryptocurrency. And when you dispose of that USDT to buy ADA, that's a taxable event. And the price of your USDT, because it's a stable coin, has probably not fluctuated in any material amount. And so you're probably, it's still a transaction you're going to want to report on your tax return. However, you very likely have $0 of gain from that transaction. So if you buy ADA with fiat, with US dollars, that's not a taxable event. However, this is a case of buying with US dollar token, and your tax rate is dependent on the rest of your activity, the rest of your income throughout the year. Also, You know, capital gains rate is a preferential rate. It's taxed at a lower rate than your ordinary income. So there's a reminder of the benefit of holding long term. All your transactions holding longer than a year, you get that preferential rate.
Awesome. Jordan, anything you want to say to cap things off?
No, Miles hit it. That's pretty much all you need to know from of using stables to acquire an asset. Like Miles said, maybe there's some slippage. Hopefully, those stable coins don't lose their peg, or else a lot of bad things could happen in the market. So technically, maybe there's a little bit of slippage from USDT or USDC or whatever stable coin of choice, going up or down slightly. But in theory, they're pegged to the dollar. There's not really much tax impact of using them to acquire an asset like Cardano in the example, but there could be in an automated software like CryptoTrader.tax, it's going to track basis for every asset. So maybe there could be some minimal slippage, but usually those transactions are technically ignored and there's no tax consequence for using the stable to acquire. It would be the reciprocal. If you offset your Cardano position for USDT, yeah, of course there will be a tax consequence, but usually going from stables back into the market, not really going to trigger any taxable, any material taxable consequence for the individual.
Right. And we are a little bit over on time here, but I just do want to say real quick. I mean, Miles touched on this a little bit already, but the tax rate you do pay is dependent on multiple factors, right? Like your holding period and your personal income bracket. Well, thanks so much, guys. Unfortunately, that's all the time we have. I know there was a lot of questions today. We do this every month, so you could catch us in February. And we really appreciate all your questions. And Miles, Jordan, I do appreciate your insights as well. So thanks so much for tuning in, and we'll see you soon.
Great.
Take care.
Thank you so much. If you have additional questions, go to our Twitter account, CoinLedger Twitter account, ask your questions there. We'll hopefully be able to answer there as well.
Yes, sir. So have a great rest of your Wednesday, everybody.